right? So our decision whether or not we want to invest in something, whether it be real estate or it's stocks or whatever investment you want to make, maybe you're buying a business, we make those decisions to move forward because we have ultimate clarity that the decision we're making is going to pay off. Most of the time, we're not gambling with it. Most of the time, we're not just kind of saying, well, I think it's going to be okay. I'll jump in. We're going to make that decision because we have a lot of clarity on it. So I want to help you make sure that you feel comfortable with real estate. Right now, it feels like it's kind of at the top. It's kind of frothy. People are nervous about the market kind of dropping, and there's a whole lot of indicators that say it won't. But just purely from looking backwards in history to support where we're at today and then predicting a little bit of the future, I want to show you what that looks like. So we'll look back on a particular property and see where it is today, see where it was in the past when it had sold. We'll use a sale date, and then we'll use a current listing. And then we're going to look into the future and see where that potentially might be based off some historical averages. Now, when I looked in the future, it looked really, really impossible. To be honest with you, I saw it. I'm like, there's no way this house is going to be worth that much money in the future. But I had to put myself back at the reference point. So I'm going to use a date in 2016 as a reference and then look at it today and see that run up and see what that actually looks. So really close to a 10-year window looking back. And then we're going to do a 10-year window looking forward. Now, to use as kind of a control, we're going to use a inflation average over the last 100 years. We've had inflation kind of ramp up and be pretty heavy, but we're going to use an inflation average over the last 100 years. It's 3.3%. And then for property appreciation nationally, that number is 4.8%. So we're going to use that as a national average. And then what I'm going to do is I'll show you the same exact results, but I'm going to plug in something more specific. This home that I'm going to look at is here in Palmdale. It's in LA County. And so I'm going to look at the LA County Palmdale market, and I'm going to do a 63-year historical appreciation look back, right? So what's the average over the last 63 years for Los Angeles County, for the city of Palmdale? And we're going to input that number and see how the results look on that. So hopefully you guys kind of enjoy this one. It might be a little bit complicated, but bear with me. I think it'll help you. Again, kind of looking back, it'll build maybe a little bit of confidence that when we're looking forward and we're predicting the future, those numbers actually might hit. And with that, I think you'll find that real estate is a great investment if you're looking in decades, not in years or months. All right. Hope you guys enjoy.
Right. So here's the example that we want to look at. And like I said, this is going to be a little nerdy. So follow along. If you're kind of technical and you like this kind of stuff, you're going to enjoy what we're going to look at here. But really the idea is to show you an example of a property that's selling today. And I did a search. I looked at maybe 4 or 5 different properties. I wanted to find something that sold about 8 to 10 years ago. So I can do a look back and I can see, 8 to 10 years ago, what was it listed for? What did it sell for? And what's it on the market for today? So this particular one fit the bill. In transparency, when I looked at the other properties, there were 3 or 4 others that didn't quite fit because they were sold many years prior, like in the 90s. I didn't want to look back that far. Actually, if I look back that far, it further supports where we're headed in the future. But I wanted to give you something that I felt was more kind of palatable, which was 8 to 10 year look back. So this particular here, this property here on Wickford is selling for just under 600,000. Now let's take a look back here at what it sold for in the past. So back in August of 2016, it sold for $410,000. Okay. Let's jump over to the inflation calculator. Now, I love this page because it actually shows you just kind of it from dates to dates or years to years, what's inflation done to our money. There's a number of reasons why I like this, but I want to just use this as a quick framework. In 2016, if you bought a home for 410,000, or if you bought an item for 410, then in 2024, it would feel the same as something for 537. All right. So kind of follow along with me right now, right? We know everything is more expensive. You go to the grocery store, you go out to eat, it's a lot more money. Your dollar isn't quite going as far. This kind of puts it in perspective. So something at $410,000 back in 16 is about the same as 537,000 here in 2024. Now, this property is listed, it's almost 600 grand. So you might say, well, that means real estate's kind of overinflated. It's too expensive. Real estate's a really good hedge against inflation. It's one of the reasons why we want to have, investments. We want to have some of our money, some of our net worth tied to real estate because it's going to pace and most of the time outperform inflation in general. It's a really, really solid hedge. It's tangible, right? We put people in there. We can rent these out. We can live in it. These are really, really good assets to hold through inflationary times. And so, yes, this is outpacing inflation, which is actually exactly what it's supposed to do. But the funny thing is, if we look at this other screen right here, I'm going to show you kind of a look back on some different years that'll help you kind of make a little bit more sense of all of this. So off on the right-hand side on this particular screen, you're going to see over the last 5 years, this particular area. So this county, so now we're taking California, we're going down to LA County, we're going down to the city of Palmdale, and we're looking at the historical appreciation for the zip code 93551, which is where this property lands. In the last 5 years, 7.22%. In the last 10 years, 6.05. And in the last 63 years, 5.47. That's been the appreciation, the average. On the next example, I'm going to use 63 years as the average or the appreciation rate, because that's such a good sample. That encompassed times that were good, times that were bad, recessions, booms, bust, all of that in between. That happened in 63 years. And so we can't say, well, we had this run up after COVID and that's why houses are where they're at. Yeah, we did, but we've also seen that before. We had a run up and then we had the financial meltdown of 2008. We had other issues back in the 90s and late 80s. So 63 years is a great sample. It just kind of shows that consistency over time. Yes, you'll have some years where the run up is pretty heavy and the downside is pretty heavy, but just over an average, 5.4% in appreciation is worth kind of taking a look at. So let's jump to one other. Actually, we're going to do a couple of different screens here, but follow along with me because I think this is where things are going to get really, really interesting for you. And I hope I don't bore you. I'll try to do my best to make it make sense. I'm going to forecast out the appreciation on this particular listing. So again, this property listed at 600 grand. This 5.4%, as I mentioned, I'm using the 63-year historical average. Now, over on the other side, I wanted to have maybe a more conservative number as well, just in case, the market doesn't quite hit. The forecast for this area is about 5.1 for the next 5 years. But so that falls somewhere in between here. Where's that 4.8 come from? That 4.8% in appreciation is the 100-year national average, not for Los Angeles County, not for Palmdale, not for 93551, 100-year for the entire nation, just in housing in general, at 4.8%. So it's basically saying, hey, after a year, if you bought that home for 600 grand, it should be worth somewhere around here, 532 to 528. Now, you'll notice down here, it's got this return on investment. It's saying 35%, 28%. That is important because in this example, I was telling the system, maybe my client put 10% down. So they put 60 grand down on a $600,000 purchase, but they got they didn't just get the return on investment, the 5%, the 5.4. They didn't just get that on the 60,000 that they put down. They got it on the entire $600,000. So the return on their $60,000 investment is 35%. On the more conservative note, it's 28%. Well, since that home sold 8 years ago, let's forecast out what things look like here in 8 years. So in 8 years, now we have a pretty big number. Now, I'll be honest, I see this number and I go, there's no way. That just seems impossible. And it's because my brain doesn't want to do the calculation. Neither does yours. Nobody wants to look at something that's 600 grand a day and think that it's going to feel like $873,000 or 918,000 in 8 years. But the reality is it does. Using historical lookbacks, using averages, and we're talking 63 years and 100 years on these averages, this is what it feels like. This is why real estate is so important, to kind of make decisions on decades, not on the next 6 months or the next year and so on. This is super, super telling. Look at your return on investment. This is one of the magic pieces of real estate. I put 60 grand down, but I got the entire 5.4% run up or on appreciation over the entire 600 grand over 8 years. My appreciation was $318,000 off my $60,000 investment. Now I know you had mortgage payments, right? We can factor all that in, but the ROI is over 500%. It's a lot more we can go into with tax deductibility and how much payments were and really narrow that down. But the return on investment is incredibly strong. And remember, because we can get loans against these, we don't have to have 600 grand just sitting in our pocket. We can get a loan on it. That's what makes these a lot more obtainable. You can't do that with like a 401k. You can't just go out and tell them, well, I want to fund my 401k for $1 million. I don't have it today, but I'm going to go ahead and give you 10 grand to get started. They won't let you do that, but you could in real estate. Okay, I'm going to show you another screen, which will really kind of open your eyes. Hopefully I haven't lost you at this point, but this is where things get super, super interesting. Let's take a look at this Excel sheet. I'm going to explain first what you're looking at in the controls or the assumptions up here. We're going back to 2016 in this case. We're buying the home at 410 grand. I'm going to make some hypothetical assumptions around a loan for right now. I'm going to say somebody got a 5.5% interest rate and they put 10% down. Okay. Their first payment started in October of 2016, and their principal and interest on their monthly payment was $2,095. They made 100 grand in income. It's not really relevant for the appreciation and the inflation here, but we'll just use that for an example. Appreciation rate, I'm going to use that conservative number of 4.8, right? That was that 100-year average. And then inflation's 100-year average is 3.3%. So I'm going to plug in, again, a 100-year average on this. This is something that's been proven for a very long time, a whole century. Now let's kind of look down here. This is payment number one. You can see the inflation. You can see what your dollar actually buys on month number one. It buys $1 because inflation hasn't really hit, but it slowly kind of bleeds off and becomes less and less value over time. That's what inflation kind of does. It erodes the purchasing power of our dollar. Let's take a look real quick at house values. So house value is really interesting because we're doing an 8-year look back. I want to show you all the way down here, 96-month mark, come all the way over to the column. What does it say that house is worth? $599,000. Was it for sale today? $599,000. It's literally right on pace using historical appreciation. But let's just say we use 6.05% because that's what the last 10 years of appreciation was for this specific property. Well, that is $661,000. Now, if you go back to the history on this property, you'll see it was originally listed at $665,000. So right on pace with that. And now they've brought it down because the market is a little bit softer right now, but it's still right on pace with appreciation. With historical averages over 100 years, it is $599. That's what's super interesting about it. So if we go back and we see, hey, these properties or this particular property is projected to be worth somewhere in the 8s to 9s in 8 years, this look back 8 years ago to where it is today really supports that. Now, if you want to really geek out, you can look at what is going on with our dollars. So when we started off, we had a mortgage payment of $2,095. Well, it's basically inflation adjusted $1,613. That's what it feels like 8 years from now because of what our dollar buys. We owe $321,000 in this particular scenario, but it feels like $247,000. Now, if you had to pay your house off at the 8-year mark, you'd still have to write a check for 321 grand. But it feels like, because of inflation and because of what happens to our dollar, it feels like 247,000. Over here, I did put another control. I put in here the rent equivalent. So I'm assuming that somebody would have potentially been able to rent that house for maybe $1,800 back then. That rent is going to feel heavier. Rent goes the other way because it's not fixed, about 2.337. So $2,337 per month instead of that 1,800. Some of these get a little bit nerdy right here. This is over a 30-year window. You know, the rent is going to feel like the equivalent of an 8% rate versus the mortgage, because you're paying 5.5%. It actually feels, because of the 3.3 and inflation, it feels actually like a 2%. That's kind of the effective mortgage rate after you take inflation out of the equation. I don't really want to geek out on that part right there, but what I really wanted to do is kind of just share and make sure that you understood, you know, these values that we're seeing right now feel like there's no room for them to go higher, but there really is. As long as you're not buying an oversaturated market. I would say in this particular marketplace, an oversaturated market would be areas with incredibly high new construction growth. That's risky because if employment and if demand slows down, then they're going to overbuild, which is going to really slow the pace. But there's a lot of people that could buy, that would like to buy, but they're afraid of the sales price. They're afraid of the interest rate, and they haven't done a deep dive into things like this. They don't know that there's mortgage tax deduction that can maybe make things a little bit easier for them. Maybe they claim more on their, or less, I'm sorry, on their pay stubs to net out more money every month to help make their mortgage more affordable, but they're afraid to because they're afraid of owing the IRS money at the end of the year. When reality is, That mortgage interest is a new write-off that you didn't have before, so you have the room to do that. These are conversations that we need to have. So if this particular example helps you, you do deep dives into any market. Every market's going to have a little bit of a different result. Every market has a different forecast for the future. Every market has a different look back 63 years from ago. But using these as just a quick average on something here in my backyard was really, really telling. I'd worked this up for a client earlier and I wanted to share it with you. Hopefully you find it helpful. Let me know if you have any questions, and I look forward to supporting you on your home purchase.